Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, pay less taxes, and have a beautiful retirement. What could be better than that? This is a show where we talk about the economy and the stock market, bonds, how to cut taxes, estate planning, Social Security, interest rates, the Fed. If it has to do with money, we talk about it right here on the Money Hour Radio, and we're going to cut through the noise and focus on what really matters to you and your money. I'm one of your co-hosts, Ben Barzideh. I have my co-host, Matt Nadeau, here.
Hey, everybody.
We are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located right here in Barrington and serving the greater Chicagoland area.
And of course, before we start, as always, we just need to take a moment and really do a shout out, say hi to all of our clients who are listening today. We want you to know we appreciate the trust you've placed in us. And of course, we love every one of you. And for you and the rest of our listening audience, we have a great show. We want to jump right in. The first segment, we're going to talk about something that we both think is a super big gimmick. It's called buy and hold direct indexing. We're going to talk all about what it is and why we think it's a gimmick.
We're going to be very nice.
I don't think it's going to be very nice to them, but hey, we don't like it. After that, we are going to get back into our ongoing discussion about the One Big Beautiful Bill Act and how there could be some higher Roth conversion opportunities out there. So we want to jump right into the first topic, but stick around later because you're going to hear all about some opportunities that may benefit you. So last week, if you tuned in with us, you know we went deep into our investment philosophy and how we manage our client portfolios. It's called Advance and Protect. And we also talked about how, in our opinion, annuities are very gimmicky, mostly sold by low totem pole advisors. Sorry, guys. Usually insurance reps. And honestly, they're just basically like a glorified CD in most cases that lock up your money for many years with draconian penalties if you try to get out early.
We also discussed our investment process, specifically our actively managed Advance and Protect tactical strategies, where we actually monitor our investments every single day, and we actually sell out of the stock market when our research is warning us that the risk of a potential crash is elevated. We don't just sit on our investments. And that's because, in our view, retirement is not the time to be riding a potential market crash all the way down to the bottom and watching your hard-earned money dissipate. And we look to sell before major damage is done. Now, contrast that to a traditional buy and hold, just ride it out concept, which is how the vast majority of people have their money managed. And that approach we talked about is based on something called modern portfolio theory, which we joked about how it's kind of like an oxymoron since it has the word modern in it and it came out in the 1950s. But it basically recommends that you diversify into a bunch of various asset classes and investments, and you just leave it alone and ride things out. No matter how good the market is doing or how bad, you just sit tight and don't make any changes.
Yeah, we lovingly call this the buy and hope strategy because basically you're just blindly buying into a bunch of different investment areas and you hope things go up. And if things go down, guess what you're doing next? Hope it doesn't go down too far or last too long before finally it starts going back up. So we agree hope is a virtue, but it's not a good strategy on its own. So one may be asking themselves, why do the vast majority of financial advisors follow this antiquated buy and hold strategy? Is it maybe because it's convenient for them? Maybe they don't know any better? I mean, are they all brainwashed? Are they dumb?
The answer to us is yes, yes, and yes, all of the above. Actually, forgive me. I don't mean to call them dumb. I just meant to have really bad luck with thinking. All kidding aside, most people could probably manage a buy and hold portfolio on their own. The advisor is not really doing anything you can't do. You just diversify and leave things alone. Might I dare to say even a caveman could do it. So the buy and hold proponents have come up with a very sneaky new sales pitch to try to jazz up their unsophisticated process. Make it sound like they're doing something fancy for you. And it's called direct indexing And guess what? Like annuities, it's very gimmicky.
Yeah, I mean, I'm going to explain what this is, direct indexing. You may have heard about it. It's getting a little more popular out there. And here's the sales pitch. You're going to be investing in the S&P 500, which would be the index in this case, as our example, but we're going to throw in some tax benefits. And when you look a little deeper, not only is it more sizzle than substance, but in fact, you actually may be setting yourself up for a time bomb in the future. So here's how it works. So one, this better be done in an after-tax brokerage account. Frankly, while we were transitioning clients over to our firm, Barzideh Nadeau Wealth Management, we saw advisors putting this in their IRAs. It's ridiculous. There's no tax benefit there, guys. But okay, I get back on to where it should be a brokerage account. So instead of just investing in just an S&P 500 index, which you can do through an ETF. Remember, you can't just buy an index, but you can do it through an ETF or a mutual fund. They decide, well, what we'll do is we'll split your money into the top 100 or 120 stocks of the biggest companies that are in the S&P 500 index. And of course, over time, some stocks will do well and carry most of the gains, but there are going to be many that go down and lose money. And so what they tell you is there will be tax savings by we're going to sell those losers, take those tax losses, and offset some of the potential tax gains from the winners. Sounds great.
But, and it's a big but, here's what really happens over time. When you sell your positions that are down, what will you do with that money? Pick other random stocks in the S&P 500? Or maybe are you going to reinvest it in your winners? Either way, in the beginning, there are tax loss benefits, but over time, you eventually sell out of all of your losers while you become overweighted and overconcentrated in your winning positions. The result is a portfolio that becomes concentrated, completely off kilter, veering far away from its benchmark it's trying to clone, with a massive amount of potential taxable gains to deal with in later years. You essentially become trapped once you get into it for a few years, as you don't want to sell out of your positions you have left and trigger all kinds of taxes that you've been deferring by sitting on them. So basically, it's a glorified S&P 500 mutual fund, and if the market crashes, you're told to just ride it out like a traditional buy and hold portfolio would.
And remember, like the old adage is you can lose far more in a market crash than what you would save in capital gains taxes. Like, remember, right now we have a very favorable capital gain tax rate. And there are, like, yes, potential tax savings, but if you take massive losses in a market crash, you'll never make those up in taxes. And just think about this from your perspective. You came to us as a client, you pay us fees, and bottom line, it's just like putting you in a single index fund. No reputable advisor would do that, but that's what they're trying to spin with this strategy. And so we kind of feel direct indexing is like putting lipstick on a buy and hold pig.
Tell us how you really feel, Matt.
Listen, I mean, we are firm believers in our advance and protect process, right? We know not everything out there is perfect, but what we do believe in is monitoring our investments daily. It's a much more powerful and dynamic way where we can look at increasing or decreasing our risk and the opportunity potential based on the actual market conditions that we're seeing. So we'll invest in areas that our research shows is gaining momentum and strength. We stay away from areas that are breaking down. And as the trend changes, we'll react to it. So if you're interested in something different, you know there's another way. We're telling you there is another way. If you want to learn more about our advance and protect process, there's a real easy way to do that. Come in, sit down with us. We'll do a free financial checkup with you where we look at your entire financial picture. We'll even go over your current investment process, see if it's working for you. If it is, great. If not, we'll go over our advance and protect process and really see if that's a good fit for you. So definitely call our office, 847-780-2980, or go to bnwealth.com. So I know we We're diving into all this investment stuff, but again, before we go to break, Ben, we've got some great, exciting news, right? We have had just such good fortune this year, right? We've had a large number of clients that have joined with us since our launch earlier this year. And again, most of whom we've had the privilege of working for years with. But there are some new faces, so thank you. We love all of you. But to celebrate this milestone, we're actually going to host our first Client Appreciation Gala this September, a night to say thank you to the families we serve. So please join us for an unforgettable evening of fun, music, mingling, and memories. It's our California Dreamin' Client Appreciation Gala, Friday, September 26th. We're going to have live music by Sounds of Summer, widely considered one of the best Beach Boys tribute bands in the country. The music's iconic, timeless, and especially meaningful this time of year.
And this is only for clients. But the good news is there's plenty of time to become a client. So to explore how you can become one of our clients, give us a call at 847-780-2980 or reach us at bnwealth.com. Don't go anywhere because as soon as we come back, we're going to talk about the big, beautiful bill.
Welcome back. Thank you for tuning in. This is the Money Hour Radio, a show where we try and help to have you grow your money, pay less taxes, and have a beautiful retirement. And we're so excited to announce that earlier this year, we launched our own independent, comprehensive, and local wealth management firm, Barzideh Nadeau Wealth Management. And of course, we're right here in Barrington, Illinois. We bring with us over 40 years of combined experience. And our fiduciary obligation of putting clients first is the foundation of our company's philosophy. And it guides every decision that we make. As an independent firm, we truly do have the freedom to focus solely on you without a corporation and their needs getting in the way of your needs as a client. And we're not just another financial firm. We actually operate differently in many ways.
No doubt. Our company motto is do great work, have fun, and give back. Giving back is very important to us, especially when it involves supporting our local community. Therefore, we are excited to announce that in the upcoming weeks, we will be launching the philanthropic arm of our company. We call it BN Giving. And we don't just talk about purpose. We actually want to invest in your purpose with you. So whether you're passionate about faith-based work, community programs, or global impact, this is our way of co-creating a financial plan that reflects your values while we partner to support your cause with you. This is how it works. If you become one of our clients and you're a faithful tither or a regular giver to a charity, as long as it's an official 501c3 organization, just let us know and we will match your donation up to 10% of the management fees that you pay us each year.
Yeah, and it's our goal to pioneer a new movement, a culture of giving, something that we think is extremely unique to our firm. It's a more altruistic and impactful way of doing business. And if we can help build and grow a client base with like-minded people, those who share our values and our vision, well, that's incredibly rewarding to all of us. And, you know, there's a lot of strategies as advisors we can work with you on for charitable giving that go along with this. There's QCDs, there's donor-advised funds. We want to help you give if that's something that's important to you. Now, if you're not a regular giver, hey, that's okay too. Like, we're here, we'll be happy to work with you. But again, we also want to be involved in the community, and this is a way to reach out and do that together. So to explore how to become a client or learn more, please reach out to bnwealth.com online or call our office at 847-780-2980. All right, Ben, so let's jump in, talk about this one big, beautiful bill.
No doubt. And for the last few weeks, we've been unpacking different parts of it each week. And today I want to focus on how higher Roth conversion opportunities are now available due to this act. And the lower tax brackets are permanent now, which is nice. And the bigger family benefits are here to stay. So one of the most significant outcomes of the One Big Beautiful Bill Act is the permanent extension of the lower individual tax brackets first introduced by the original Tax Cuts and Jobs Act of 2017. That means lower tax brackets and bigger family benefits are here to stay, like I said. Current tax brackets, by the way, are 10%, 12%, 22%, 24%, 32, 35, and 37%. Those will remain in place indefinitely. And this is especially important for middle and upper middle class income earners, including many federal employees and retirees who often fall into either the 22% or 24% marginal brackets. And for joint filers, for people married joint, this covers incomes between approximately $100,000 all the way up to $400,000. So there's a good range there. And for single filers, it's roughly half of that range.
And Ben, in reality, like as we work with a lot of pre-retirees, we see that range. But with retirees and in retirement, we often find it's pretty easy for a couple to be in the 12% bracket and still have a very comfortable level of income, because that tax bracket goes all the way, like you said, almost to $100,000 of taxable income. And that's taxable income means after any deductions. So along with these brackets being permanently in place, in addition, this almost doubled the standard deduction, which was one of the original hallmarks of the Tax Cuts and Jobs Act. That was maintained. So now we have a much bigger standard deduction that simplifies tax filing for most Americans, reducing that need to itemize. And in fact, since the introduction of this provision, the number of taxpayers by a percentage who itemize dropped from about 30% to under 10% of the population now itemize. And they even kicked in a few extra family-friendly provisions. The child tax credit, which was set to expire, is now permanent at $2,000, and it will increase to $2,200 in 2025. And even better, they will now start indexing it for inflation starting in 2026, helping families keep pace with the cost of living.
So here are some key potential opportunities for a retiree or retirees to take advantage of. And I'm talking specifically in the form of partial, or sometimes we call it micro Roth conversions. And if done right, over the course of a few years, one may be able to completely convert their pre-tax IRA to a tax-free Roth IRA while controlling and minimizing the tax hit. So let's look at an example. Bob and Mary are over the age of 65 and they are retired. For income, they rely on their Social Security benefits and a pension that Bob has. And let's just say combined between the Social Security and the pension, they have an annual income of $86,700 in 2025. But because they are over the age of 65 and the standard deduction has increased big time for seniors, and that's due to increases in some temporary provisions that actually add another $6,000 a year per person or $12,000 a year for married couples to the standard deduction. So for them, in my example, the total standard deduction is a whopping $46,700.
I mean, that's huge. Here's the thing, what you just hit on is that if you're a senior, you're over 65, and you're married, you're getting this much bigger addition, an additional $12,000 of a deduction. That only lasts 3 years, so you've got to take advantage of it over the next few years. But let's just use that example with this Bob and Mary. That basically means if they're at that $86,700 you mentioned, Ben, and this giant deduction, now they only have $40,000 of taxable income. That easily puts them in the 12% bracket, which, you know, the range right now is from $23,850 up to $96,950. So they've got basically another $50,000 of taxable income, and they can stay in this 12% bracket. And this could be a golden opportunity to then do a big $50,000 conversion this year in this specific example. And again, think about it. If you can repeat this strategy over time, it can be powerful, where if done right, you may be able to convert a lot or completely convert your pre-tax IRA to a Roth IRA over the course of a few years while minimizing some of the tax hit. Now, Go ahead.
Well, there's a couple caveats you should be aware of. I'm going to elaborate a little bit more on this opportunity. There are some kind of gotchas you got to worry about as well. But one of the big benefits of doing these partial Roth conversions and chipping away at your pre-tax IRA is that once you are age 73 and you're forced to take income out of your pre-tax IRA, well, if you have a big IRA, that can lead to a good amount of income you got to take out. And then that on top of some of your other income could push you into a higher tax bracket. It could start causing your Social Security to go up or your Medicare Part B and Part D premiums. So this can help keep that in check by strategically over the course of a few years, chopping away at that IRA and making the amount smaller and hopefully a point that's not going to trigger extra taxes later in life.
And remember, if you don't use that Roth money in the future, your heirs, like your kids, they inherit that tax-free as well. So again, one big caveat I want to touch on before we say that this is a slam dunk. You do need to be careful if you're collecting Social Security and you're in the 12% tax bracket. There is something called the Social Security tax torpedo, where if you start taking on additional income from Roth conversions, you may see your Social Security tax also increase. So you do need a professional to analyze this, because what you don't want to do is just willy-nilly just do these meat axe approach and end up paying a ton more tax than you expect because of how it impacts your Social Security. So it's critical to look at all of those aspects before doing this.
No doubt. But before we wrap up for this week, we just want to announce that at BN Wealth, we've been incredibly fortunate and blessed to welcome a large number of clients since our launch earlier this year, many of whom we've had the privilege of working with for many years, and some new faces too. And to celebrate this milestone, we're hosting our very first Client Appreciation Gala this September, a night to say thank you to the families we serve. So join us for an unforgettable evening of fun, music, mingling, and memories at our California Dreamin' Client Appreciation Gala on Friday, September 26th. You will enjoy live music by the Sound of Summer, widely considered one of the best Beach Boys tribute bands in the country. And their music is, of course, iconic, timeless, and especially meaningful this year.
Yeah, and we're going to have this at a beautiful country club. It's going to be a wonderful night of dining, dancing, and drinks in an atmosphere you don't want to miss. This is available to clients only, but the good news is you've got plenty of time to still become one. So if you want to explore being a client, go to the website, bnwealth.com, or call our office at 847-780-2980.